All right, we are live here, and time to thank you guys for a little bit of patience. A couple minutes after the hour here, we wanted to make sure that everybody could hear everything correctly, and I hope that you are. And if there's any issues with seeing the stream here, just let us know in the chat, and we will try to get that fixed for you. But thank you for joining this afternoon. It is late in the week on a Friday afternoon. I hope everybody had a fantastic week. The markets just closed. An update today. So maybe a sign of things to come. Who knows? There's been a lot of volatility. I think all we can say is there's probably still some uncertainty. So make sure that you're watching your risk out there. We hope that you have had a great week. And so what we're going to do today is we're going to play around with a new portfolio. One thing that we've been doing at RiskSmith is we've been having some fun playing with these local city portfolios, putting together portfolios of different companies in various cities across the U.S. and seeing just how easy it is to put together a portfolio of companies that really can beat the market in terms of how well it trades risk for reward, its historical growth and volatility. And ultimately, the whole idea behind this is to have some fun and build a portfolio live in just a few minutes and show you how easy it is to actually build a portfolio of companies that work together. So let's dive in. We're here based in Tampa, Florida. We have team members all over, and a big shout out to all the team here that helps us, that is all over the place. But we do have a great Tampa presence, and it is one of my favorite cities in the whole world. And so let's build a portfolio from companies in my favorite city. So I have a list that I was happily folks put together for me, luckily, of some public companies that exist in Tampa. And so what I'm going to do is I'm going to go from that list. We're going to start to go through it. We're going to look at some of these companies. We're going to pick some out. We're going to talk about what they are. We're going to look at how well they perform. And ultimately, we're going to see if we can make a portfolio that really works well. So let's get to work and let's start looking at a few Tampa companies. So we'll start with one of the big ones that you guys may have heard of before, Mosaic. Mosaic is based here. They do a lot of stuff in phosphates and fertilizers, that type of stuff. So here they are. Let's look at how Mosaic looks just off the top. You know, this is RiskSmith, and what we're looking at here, if you've never seen this software, this is our software. It's completely free to use. You can go sign up right now at app.risksmith.com, or just go to risksmith.com, hit the sign up link at the top of the website. That's probably the easiest way to do it. And you can jump in and start building portfolios just like you're about to see me do here. And a few things that we show you, I'm going to give you a little primer on what we're going to be looking at here. We're going to look at a few different scores, a few different numbers that we give for each company and what that means and what it means when you put together a portfolio and optimize for those numbers. So check it out. I'm looking at Mosaic here. Hopefully you can see this on my screen. You can see that it's got a few things down here I want you to pay attention to. We have a thing called a D-score. 4.03%. D-score is simply this. This is the minimum amount of money that you need to know that you're probably going to lose in this thing once a month. Now, you might gain a lot more than that, so you shouldn't be nervous about losing money because that's just something that's going to happen. You have to lose to win, right? But this D-score is going to show you that if you invested just in Mosaic, then you need to be comfortable, historically speaking, you need to be comfortable with waking up or ending the day, looking at your portfolio and noticing that you were down at least 4% in one day. That makes you nervous? Maybe get your portfolio D-score down. But we're going to look and see how we combine things together and what happens to the overall D-score of your portfolio. So this also has a risk efficiency. This is how well this trades risk for reward. Essentially, the cheat sheet on this is you want it over 0. You really ideally want it over 1. Over 2 is pretty good. Over 3 is really good. Over 4 is exceptional, and higher than that, it's just really, really great stuff. And then finally, growth. We know what growth is. So let's go ahead and add this to a portfolio, and let's start building a Tampa portfolio. So let's start with Mosaic. We need a place to start here. Oops, I didn't quite hit the landing zone. There we go. All right, so we're going to put this in here with Mosaic. We can see the risk efficiency now, and we can start to, right now, this is going to look just like the individual item. And what you're seeing here is this is a histogram, right? So what this histogram is showing you, it's pretty simple. We just took a year of returns, daily returns for this portfolio, and we just mapped it on a histogram. These are 0.5% increments, 0 to 0.5%, 0.5% to 1, and the very edges, the very ends are plus 5% over here and minus 5% over on the negative side. This gives you an idea of what it's going to be like to invest in this portfolio, right? Because if it's a nice smooth shape, most things near the middle, every day it's going to kind of trudge up, maybe lose a little, gain a little, lose a little, gain a little, but hopefully gain more than it loses over time. It's going to be a smooth ride. As this thing stretches out like this and the ends get bigger, you start to get these single days where it's up or down 5%. And you can imagine that starts to look like volatility, because it is, and it can start to make you nervous. So that's how you can use these histograms to really understand what's it going to feel like to invest in this thing. So, okay, we got a 1.91 risk efficiency and a 4.03% D-score. Here's what I want. I would love to get that risk efficiency higher, but right now it's pretty good. The D-score is pretty high. So I'd like to put another thing in here to work with Mosaic to help bring that D-score down, but keep the growth and risk efficiency, hopefully, to make it less volatile, but still just as performant. So let's look at another one. Duke Realty Corp. Now, I'm not familiar with Duke myself. Not really sure what they do. I mean, they're a real estate development agency here. So industrial, office, medical. Okay, great. D-score of 1.8%, 1.88. Much less volatile, right? 2.13 risk efficiency. I'm loving it. Over 2. This is looking great. And a 36% growth over the past year. Come on, 36% over the past year. I'll take that. So let's go ahead and drop that into our portfolio as well. So now we officially have a portfolio. We have 2 positions, both Tampa companies, mixed together, and already we're looking pretty good here. 2.85 risk efficiency, 1.74% D-score. Did you see how that dropped? It went from 4% to 1.74 just because I added this Duke Realty Corp in there, and it balanced out Mosaic, right? So we get to invest in both of them, right? Which is awesome, but we get to make sure that every day we're not getting slapped around by the volatility. Let's keep going. I'm loving where we're sitting right now. Over the past year, this portfolio will have made 51.44%. You can see here how it outpaces the S&P and outpaces the Dow as well as the NASDAQ. Look at this difference here. Pretty incredible. All right, let's see what else we can come up with. Well-built WBT. All right, well-built. Wow, look at this. This is a wild histogram. Look at this thing. Barely moves, and I don't know that it's actually, man, you know what this looks like? It looks like it was acquired. We sometimes see this where you'll have an asset that has this kind of ride, and then all of a sudden it settles out, and often sometimes it gets pulled into, I think it's part of an SPAC or it gets acquired and that kind of thing. So I'm not going to actually deal with this one because it looks a little funny. Let's go to Kforce. Kforce, great local company. They're in staffing, and they have hosted bar camp technology camps here, which is great. Okay, so here's Kforce, 2.95% D-score. It's going to be a little bit more volatile than our portfolio, 1.37 risk efficiency. Let's see what happens when we drop it in. All right, 2.73 risk efficiency, still looking really good, getting better, really. And our D-score went up, so this is getting a little bit more volatile, but we expected that. We added something that was more volatile, and so we kind of knew that was going to happen. I'm still okay with it, my personal thing, and you have to find the D-score that makes you feel good, right? At the end of the day, losing 2% a day may make you feel crazy. And if it is, you just want to make sure this number's below that, right? Because you know that you can expect to lose this much in one day every month or so, like once or twice a month. This is 20-to-1 odds, basically. And so if this makes you nervous, work on getting it down. I'm personally 2%. I'm okay with that because the reward I'm getting on the other side to lose 2% a day every now and then, but still make 48% over the course of the year, I'm good with that trade-off. All right, let's go. Raymond James, big financial company here. So far, look at, we can start to think of this in terms of how these things complement each other, how they correlate to one another. We've got some real estate here. We've got some kind of industrial materials, mining, and some personnel, staffing. And so I like the idea of putting a little finance in here. Because, all of these industries, these sectors, right, they have different levels of correlation to one another. And so if we build things that are uncorrelated, we have a better chance at those things not all going down at the same time, right? And you can actually see that in this covariance matrix. The darker the colors and the intersection of two things, the less correlated they are with one another. So we make it really easy here. You can look at that and you can see Mosaic not very correlated with Duke, whereas it's relatively correlated with Raymond James. So when we added Raymond James here, D-score came down. Risk efficiency is still good. Growth still at 44% over the past year. I'm still liking where we're headed here with this portfolio. So let's keep going. Jabil Circuit, big company here in Tampa, multi-billion-dollar market cap, if I recall. Okay, great, 2.17 against 1.9. We're still back up to the 1.99. So Jabil's a little bit more. It was a little bit more volatile. I'm actually going to take that out because honestly, it brought my risk efficiency down. It brought my D-score up. Those are both going the wrong direction, so I don't kind of like where that's going. So let's pull that one back out. OMEX. Let's check out OMEX here. Odyssey Marine Exploration. And you can look at the histogram. This is going to have some volatility. This D-score is going to be, let's see if I can guess it, close to 3%. Ooh, 4.37 risk efficiency, negative 0.3. You can see, look at this thing headed right down a hill. We're not really interested in Odyssey right now. Just not performing the way that we would like it to. Bloomin' Brands, we like our Bloomin' Onions and all of the other great restaurants that they have. It's really volatile, not performing well at all. Negative risk efficiency. Again, look at this. This is the past year. So we're also going to pass on Bloomin'. And this is kind of how you can easily screen through stocks that you hear about, right? Things that you hear about, just come put the ticker in. This is the stuff that you're not going to see. You're not going to see this stuff in your brokerage account. They're not going to show you. They're not going to show you this number. They are not going to show you this number because they don't want to dissuade you from buying stocks at your brokerage. They want to encourage you to buy stocks at your brokerage. So just like come to RiskSmith, or even you can go to app.risksmith.com/explore/ just put in a symbol, and you can get these numbers for free without even signing up. So, it's a good thing to test because you could look at something like, you could say Jabil or Bloomin' Brands, right? And you could say, man, those are big companies I've heard of and I like, and I bet they're great to invest in. But the reality is you really have to look and see not just the growth of it, right? But how well, does it trade every pound of risk? How many pounds of reward do you get back? And you want more pounds of reward for pound of risk that you're putting in. Ultimately. And so, just come check them out. Just make sure it's all good. Let's look at Primo Water. PRMW. Primo Water. All right, Primo Water. Let me, what's happening in my computer here? Why is that not, that's an odd thing. Let's just see what happens when we add it. A little menu thing on that that's certainly interesting. That one does not help my portfolio out. So we're not going to put Primo Water in there. MarineMax. I have such a soft spot for boating and boating related companies, just from a personal standpoint, because I love the water. Oh man, but sorry, MarineMax, you are not in great shape. And it's been a rough few months for a lot of equities out there, right? I don't have to tell you this. If you're invested in the stock market, then you know that it has been a crazy few months. Here's one with at least near a 1 risk efficiency. D-score is 1.96. I just don't love this. Roper Technologies. If I add this, this is going to drag my risk efficiency down probably and push my D-score up, but there's only one way to really find out, and that is to add it and see what happens to our portfolio here. Yeah, it did about exactly what I thought it was going to do. Not loving it. Let's go look at SeaWorld. Seas here? Where are we at? All right. Yeah, also quite volatile. So I'm not going to do that one either. And this is what I've seen this before. We've I've done some Tampa portfolios in the past, and there's a lot of companies here. This is an area of the country, and not that all of these are local companies. A lot of them are headquartered here and they're national, but we have a lot of tourism, a lot of retail, a lot of entertainment that past 2 years has not been great, right? It's been a tough couple years for those sectors. Let's see, Brookfield Residential. See what happens when we put Brookfield in here. Not great. Not great. All right. Let's see. I got a question here. Dan, how are the allocations sort out when you drop an asset? That's a fantastic question. I didn't talk anything about that, and I'm really glad that you asked that question. When I'm putting these assets into this portfolio, you might notice that it's telling me how many shares, 91 shares, 31 shares, 39, 50 shares of this, right? And that is showing me showing me how many shares of each one, the relative position size of each one of these. And we do this for you. When you create a portfolio in RiskSmith and it's simulated, we give you some weighting. We give you an allocation to start with, a place to start. And what we weight this based on volatility. So the way that this works is we take all of the positions in this portfolio and then we say, hey, okay, what's the most volatile one? Make it the smallest part of the portfolio. And what is the most or the least volatile one, and make it the largest portion of the portfolio, all relative to each other's volatility. And that's how we're getting these share amounts here. And you can see you can switch this also over to equal. You can see how it changes, right? Because now we're saying this would be your numbers if you equally weighted them. You can see that the risk efficiency comes down, the D-score goes up, and that's because we're not weighting the volatility against each other. And this is the real magic and power of building actual portfolios, not just having lists of stocks that you invest in, but real portfolios that work off of each other. So this allocation works with this allocation because you can tell, like, if you just invest in things equally versus volatility weighted, look at the difference in the risk profile here, and it will also have a difference in your growth as well. It turns out in the growth here over the past year, equal weighting was actually better than volatility weighting. But to get that growth, you had to put up with a lot more risk. So it just depends on your tolerance and how you want to do that. By the way, if you ever want to come in here and create your own portfolio, just flip that over to managed, and then you can put your actual shares in from your brokerage, and you can see exactly how yours stacks up. Let's add a few more here and see if we can get this working nice. HCI. Let's see. HCI group also looks very volatile. Let's see where we end up. 2.1 with a 1.9 D-score. I'm fine with it. Let's keep it for right now just so we can work through this. West Rock. Let's see what adding West Rock does to our portfolio. Ooh, no. Goodbye, West Rock. I don't think. And I'm doing this a little bit quick in order to kind of speed through this so that I don't bore you guys for too long. But obviously, you want to go in and look at these. You can go in and look at each one of these companies individually. And I don't have to add it to my portfolio to know that this is probably not going to help me very much. Straight downhill, pretty volatile. It's probably not something that I want to be adding to my portfolio. I've got LMFA here. Look at these fat tails. I want to show you guys something here real quick. Look at this. This is, you don't really often see too many histograms that look like this. You do in cryptocurrencies, but you don't as much in public equities like this. This LM Funding America, I'm not even sure what they do. We don't have a description for them right now, but this has a D-score of 9.16%. That means if you invest in this company, you have to be prepared to once or twice a month look at your brokerage account and go, I was down 9.1% today, and be okay with that. It would make me crazy. You can see it's very volatile. We're not going to add that one to our portfolio right now. Kimball Electronics. Okay, let's see how this looks here. Nah, also has not done well this year. A lot of stocks in the local area here that have not had a fantastic year. But this is a great way to kind of go through those and really ferret out like which one of these is going to be good. Now, Allegiant Airlines just probably got hammered with COVID, right? I mean, and they did. Look at this. The stock price has just been on a steady downward cycle. It is anti-risk efficient with an almost -1 risk efficiency. Let's see. Let me think if I can think of any more. Anybody watching out there have another Tampa company you want to see the symbol added here to this portfolio? Curious how that will affect our portfolio. Right now, we have 37.59% growth. We've got a D-score 1.9%. I'm okay with seeing 1.9% a day gone. Not every day, but once or twice a month, that's okay. I can deal with that, right? In order to make 37.5% over the past year, I'll take that trade-off. Absolutely. Let me see if we have any other assets that we can add. I'm trying to think of other Tampa companies that I might know of here that might have an opportunity to beef this thing up a little bit. I don't think Sykes Enterprises used to be traded, and I don't think they are anymore. We did just have Kathy Wood move to town, and ARC, right? And ARC has actually been having a little bit of a tough time here over the recent little bit. But ARC, look at this. Like, here is the ARC Industrial Innovation ETF, right? It's had a little bit of a tough time over the past little bit. As you can see, it really, near the end of last year, really started to take a nosedive down. Right now, these are my 5 companies. Now, ideally, in an ideal world, right, we're doing this kind of fun. We're making a city portfolio. You probably want to have more positions than this if you possibly can, because, the idea is to have enough positions that work off of each other so that one thing's down, another thing might be up to balance it. And that's really going to help you hedge your risk, and it's going to help you get a much smoother ride up the ramp instead of getting slapped around all day. So while 5 is fine as a great place to start, and really if you have nothing right now, a portfolio of 5 companies beats a random list of 20 probably any day of the week. So this is a great place to start, but I would also probably work over time to add more to this, and I will be adding more to this as I discover more public Tampa companies that I think may have some good performance and that we might want to take a look at. But for right now, where we ended up in this portfolio, we built this portfolio in 20 minutes, basically, right? And I've yacked a whole lot of that. So I probably could have built this portfolio in about 10 minutes. But we've put together a portfolio of 5 companies that work off of each other pretty well. They have a reasonably good, like, bell curve kind of shape to their returns. The risk efficiency is over 2, so it's trading risk for reward pretty well. It's only going to lose, it's going to lose at least 1.9% probably twice a month. It may lose more than that, but this is about what we can expect to count on, and I'm okay with that. And it's going to generate 37.6% over the past year. Now, we don't know what it's going to do this year. This is not a prediction. It's the past year, but the past is the best thing we have in order to inform what might happen in the future. We will make this public, and we will share this. You can flip any portfolio to public and just share this URL, and anybody can see the portfolio you've built without knowing how much you've invested in it. We'll share this on the website, RiskSmith, as well. If you have any other Tampa companies. I've got a couple last ones here. NLSN and ROP. We tried Roper. NLSN. Let's look at NLSN. What is NSLN here? Oh, Nielsen. Oh, man, they're like 5 minutes down the road from me. I can't believe I didn't think about them. Sorry, Nielsen. Not looking so hot. So thanks, Ryan. I appreciate the idea there for Nielsen and Roper. Unfortunately, I just don't think they're going to be a fit. I hope you guys have enjoyed this. Throwing together a Tampa portfolio. We'll keep adding it to you, and we'll keep you updated on how well this portfolio performs over the course of the next few months as this market volatility hopefully works itself out. I hope you guys have a fantastic and relaxing weekend. Don't think about the markets. Don't think about the craziness. Relax and pull your head away from it if you can. And remember that staying in the game is really the key to winning long term. Hope you guys have a fantastic